historically, when you're in a stagflation, and I do believe that's where we're heading, that's the best time for gold. When growth isn't very good and when inflation is going up, gold is probably one, and silver is one of the best things to own.
Welcome to Smarter Markets, a weekly podcast featuring the icons and entrepreneurs of technology, commodities, and finance, ranting on the inadequacies of our systems and riffing on ideas for how to solve them. Together, we examine the questions: are we facing a crisis of information or a crisis of trust? And will building smarter markets be the antidote? This episode is brought to you in part by Abax Exchange, bringing better price discovery and risk management tools to navigate today's commodities markets through centrally cleared, physically deliverable futures contracts in energy, environmental, and battery metals markets. Smarter markets are here.
Welcome back to Gold for the 21st Century on Smarter Markets. I'm Dave Greely, Chief Economist at Abax Technologies. Our guest today is Gregor Gregerson, founder of Silver Bullion Group. We'll be discussing the role of gold and precious metals in protecting wealth, the physical infrastructure and technology required, and why creating and maintaining trust remains the foundation of a functional financial system. Hello, Gregor. Welcome to Smarter Markets.
Thank you for having me.
Well, it's a real pleasure to have you here. I'm really appreciate this opportunity to talk with you. Clearly, many people are now talking about gold and looking to gold and to the precious metals markets broadly to protect their wealth in the current circumstances. You've been building out the infrastructure that's required to protect wealth in this way for over 15 years. So I think it's safe to say you were ahead of the curve on this one. So I wanted to ask you, what set you down this path? What were you seeing that perhaps others weren't?
Well, it goes back to 2008. I was senior data architect for Commerzbank. And at that time, I'd already moved to Singapore. But I was sent back as an expat in Germany, my own country, basically, on a special project. And that was around the time that Lehman Brothers went bankrupt. And so I was in the trading room of a major bank, seeing the after effects of the 2008 financial crisis. And it became very clear to me that the whole system was based on trust. And, we had one trader in Germany. He was sort of named the dumbest trader in Germany because he sent, I think, $40 million to Lehman Brothers hours before he went bankrupt. And, nobody wanted to become the next dumbest trader by sending it to any other bank. And, that's really how the system was about to collapse. And I think not too many people realize how close we really got to this, all of this falling apart. And in my prior life or early career, I used to work with quants on structured product desks, building derivatives. So I was familiar on how derivatives basically are made up with components from different banks. And, so very safe if everything works. But as soon as you take some pieces out, the whole thing becomes unsound. And hence you've got the too big to fail problem. So seeing all of this and so scratching my head, I saw people going out and buying physical gold and silver. And I started reading some books about it. And by the time I thought, hey, that's not a bad idea, I couldn't get any. I went through 15 banks in the Frankfurt area in Germany and bullion dealers. And almost everybody told me, well, we're buying back, we're not selling. And if they're willing to sell, they were buying it back at a huge premium. Silver had fallen to $9.50. And people wanted $36 for a bit of silver. And that really made me realize that physical gold and silver is all about removing counterparty risk. And when you have a crisis, counterparty risk is really the big problem, because you might have 100 ounces of gold somewhere, but it might not be worth anything because your counterparty is dead or because the gold might never have been there. But if you have it, under your bed, you have it. And that was sort of the beginning of it all, because I realized we're going to have bigger crisis. And for the next crisis, I wanted to make sure that we have physical gold and silver available and stored in a safe way. And that's really how it all started.
And lots of people get involved in precious metals markets as an inflation hedge or portfolio diversification. And there are lots of ways to invest in the space, whether it's physical, whether it's futures, whether it's an ETF. Your focus on wealth protection and counterparty risk really affects the way that you invest in precious metals by wanting to hold physical, as you said. And so I'm curious, what infrastructure did you have to build in order to be able to hold wealth in this way?
We did a lot of things differently, and I didn't start out this way. It was very much a learning journey early on. When we started building this, we didn't realize that the system itself wasn't really meant to provide systemic wealth protection. When people own gold, oftentimes they just own price exposure, and there's no physical gold behind it. Or the gold might be unallocated, which is a nice word of saying, it's been sold 50 times. Or even if it is there are some issues with it. And as we were looking at creating this storage system, we were outsourcing, like most companies do, to one of the big international global vault operators. And as I went through the contracts, there were two big issues which I just couldn't live with. One of it was a statement in the contract that if the bullion mysteriously disappears, it would not be covered by insurance. So, of course, then you start wondering what is mysterious disappearance, and you start wondering at night, if it's mysteriously disappears, then what now? So that's something that we wanted to change. And by the way, the reason I can go into details why there's this clause, but usually insurance companies or insurance vaulting contracts have an all risk insurance. And people think all risk insurance means all risk covered, but it actually means all risk covered unless excluded. And if you don't know your list of exclusions, you really don't know what is you're insured for. And so all the mysterious disappearance is just the most important exclusion, which I wanted to get rid of. The second issue was there was a force majeure clause in the contract, which essentially stated that if any government nationalizes, seizes, or confiscates your gold or silver, you have to indemnify the vault operator. And so my point of view is I'm putting my gold in Singapore. I'm aware that I have to follow Singapore law, but I don't want to have to follow Burundi law or whichever other country might be in there. And so this is any government law, I couldn't live with that, and mysterious disappearance I couldn't live with. And the only way of changing that was to build your own vault. And so we basically started with this idea, well, how do we build a vault? And the best way to build a vault is to start talking with the insurance company, Lloyd's of London in this case, and start to look at how do we build a system which the species inspectors, which are the insurance security specialists of insurance companies, would approve. And so being a software engineer, I basically started developing our vault management systems and building them in a way that creates a lot of checks and balances. When bullion arrives, it's being split into between 3 functional groups into 9 tickets, which are processed in a certain way. And that essentially gave a lot of confidence to the species inspectors. They gave us very high marks. And essentially, we managed to get insurance through Lloyd's of London, which included mysterious disappearance. And then, because we said we're only a local company, we're only storing in Singapore, we did not have to have a force majeure clause saying any government. And so my point is, sometimes it's better to be local rather than global. And these were two key sort of directions that we took. A third issue was a vault usually only store on a set to contain basis, which means that if gold is being deposited, that gold, if it turns out not to be real, it's not the vault's problem. So is it the seller's problem? Well, he will say I bought it from somewhere else. So it gets very complicated on who's really at fault when there's an issue with the gold. And sometimes the customer is the one who's going to have to fight his way through trying to get somewhere. And I didn't like that system. And I said, well, why don't we look if we can have a reliable way of non-destructive testing for precious metals? And we developed the system back in 2011. By 2016, we felt comfortable enough to guarantee all the gold that we are selling, all gold that's being transferred in, which went through this testing system. So now we are essentially guaranteeing that bullion, and essentially the buck stops with us. If there's an issue, we are the ones which are going to be liable. And the system has worked very well for the last 12 years. And about a month ago, I presented the system at the LBMA conference on assaying and refining, essentially, to analytical labs of the biggest refiners in the industry, which are also very interested in it now. So it works well, and the system relies on testing multiple characteristics: electric conductivity, ultrasound, X-ray spectrography, magnetism, density. We do at least 3 tests. If these pass, it's almost impossible for it not to be real gold. And so there are ways to essentially make sure and provide certainty. And by addressing these 3 key issues, as well as making sure all of the bullion is always owned by the client, never on our balance sheet, we can essentially remove most of the counterparty risk, most of the jurisdictional risk, and the currency risk, which I think are the 3 key risks that we are facing in a systemic crisis.
Well, I'd love to dig into a number of the things that you've said. I found them really interesting. First of all, I've got to ask about this insurance exclusion of mysterious disappearance, because on its face, it sounds like if I had auto insurance and my car was stolen, it wouldn't be covered because it mysteriously disappeared. I imagine it's a little more technical than that. What do insurance companies mean by mysterious disappearance?
Well, when you're storing gold, let's say there's 3 sort of main causes for something going missing. One is theft, third-party theft. That's what people usually think about. Somebody comes in gun blazing or at night drilling and stealing the gold. So if that happens, then what would you do? You will call the police. The police comes, does an investigation, writes a police report, says somebody stole it. It's not recovered. It goes to the insurance policy company and they pay it based on the police report. Another case is infidelity. So if that's, let's say, an employee or somebody in the company pocketing some of the gold somehow, or in some other way misappropriating that gold. And if that can be proven, then it's a case of infidelity. Again, there will be a police report. It goes to the insurance pays based on the police report. But what if we have an inside job or a theft and we don't know what happened? Or what if we get a shipment of 100 bars of gold and we don't count it correctly? There's really only 99, but we think it's 100. So we are storing it now as 100 bars of gold. And 3 months later, we come and we realize, it's only 99. If we go to the police and say, we thought we had 100, but they're only 99, police is going to say, well, too bad for you. It's just not much that they can do. There's no way of determining what that was. So that's mysterious disappearance. So if we now go to our insurance company and say, hey, we thought we had 100, we only have 99, could you please replace that 1 bar? It's only $140,000. The insurance will have to pay if you have mysterious disappearance, or would not have to pay if you don't have it. And so it takes a lot of trust by the insurance company to give you this kind of policy, because currently we have a policy of $1.5 billion US dollars. It's Singapore dollars, so that's about $1.2 billion US dollars. And so I could lose $1.2 billion US dollars mysteriously, in theory, make a claim for it. And so that is the type of reasons why it's difficult to get this kind of policy. And you have to pay a little bit more, but most importantly, you have to gain the confidence of the species inspectors that you have enough systems in place to make it very unlikely for mistakes to happen.
There's a word you keep using, and that's trust. And I think for many people, trust is kind of an abstract concept, but in your world, it's very practical. There are real implications of when you can't trust someone else, whether it's the counterparty risk, whether it's being able to obtain insurance. How do you think about trust and establishing trust or removing the need for trust in your business?
To us, trust is everything. So I say, building and maintaining trust is the number 1 goal of the company. Sales are secondary, because I see the whole financial system. I see the United States dollar. It's only backed by the full faith and credit of the United States. If there's no trust, all these systems collapse. And so what we are trying to build is a system that is outside the financial system, which can be trusted when trust in the existing system disappears. And that's why trust is so important. And you cannot ask people to trust you. But what you can do is you can build systems which are either so transparent or which put other constraints or checks and balances on you, so that as people understand how it works, it starts building trust. And so that's why this is so important. And oftentimes, you have to take some entities like Lloyd's of London and the species inspectors to come in to basically certify or verify, yes, these guys know what they're doing. Therefore, we're willing to take that risk And so that's building trust. And that's why when you start a vault and you're trying to convince somebody on the other side of the world, like you are right now, literally, to send the money over to a no-name company, you need to have a way of establishing the trust. And insurance was a very important part of that. But then everything else we do basically is to keep on talking with clients, finding out where the pain points are and developing it. And so we have a lot of, let's say, paranoid in a good way clients. And I myself am the same kind. So we'll just go ahead and we'll talk, and what about this scenario and this scenario? And, people tell us, yeah, but you should be thinking about this instead. And we'll say, yeah, we have thought about this, but have you thought about this other issue which could happen? And so we kind of geek out on our risk assessments and how to handle it. And after 17 years of that, we just sort of live and breathe it and play through scenarios of what might be happening. And it just has grown and grown. I mean, it started off very, very small. Basically, it was my own $130,000 by myself to some degree. And now we're one of the largest vaults in the world with 10,000 ton capacity for silver. So it's about 32% of all production on silver. 15 gold vaults, and we can expand it to another 25, so up to 40. So I never expected to become this big, but it was just sort of a consequence of what I would see as the obvious thing to do. Because to me, it seemed obvious that you don't want your gold to mysteriously disappear. So you only have one government that you have to listen to, or said it should be tested. And other companies didn't want to address these issues. And to us, it just seemed obvious that we have to.
Were there any big moments or insights in this journey of building trust with your clients that have kind of stuck with you? Like something where you're like, oh, I hadn't thought about that, or that was really important in getting people to be able to trust us?
I think it was a continuous learning process, but it all started because I myself wanted to build a system which was as foolproof as possible. So that was the beginning sort of it. It was never really about making money. It was about finding a system which is going to be resilient and survive that financial Armageddon. And as we built that, I think a lot of the key questions sort of were addressed early on, and then it was a matter of sort of improving as we went ahead. I think what I had to learn along the way was to be concise and don't keep on talking about things, because I like to talk and I will write 10 pages about a subject and nobody would want to read it. And I realized maybe I'll try 1.5 pages and people still don't read it. And I'll just have to try to get it down to one paragraph and ideally make a short video or something. So it was a matter of me sort of becoming a bit better at communicating.
Well, I'm glad you're communicating with us today, and feel free to talk as much as you like. This is really interesting. The one other piece you had brought up that I wanted to go back into with you was the testing that you talked about to make sure that what's going into the vault is what's been stated. And I'm curious, how does that work? Is it a sampling of the bars that come in, or do you test every bar? Like, how scalable is this procedure that you've developed?
It depends a little bit from the source. If we have a transfer from another vault, so we have quite a lot of clients essentially which will transferring from another vault or sometimes from their home, then we test all of the bars. The items that are harder to test are the coins, because there's so many of them. You get a 1,000 ounce bar, that's one up, $32,000, quite easy to test. But you get 1,000 coins, that's a lot more work. And we have to open the so-called monster boxes, which are usual in the industry. It's just a little strap, so that's not really a seal. So we open it, we test about 30% of the coins, and there are some ways of testing coins which are quite practical. If you run them near a magnet, a rare earth magnet, for example, silver and gold, they tend to repulse magnets. Whereas tungsten, which will be used for faking of gold, for example, because of very similar density, will attract it. So as you run a magnet around it with device which measures the magnetic attraction and so on, you can pretty quickly get an idea if there's something wrong. And it's the trick really of our testing, which is what was an insight to the LBMA refineries and so on, which I didn't realize that it was for them, was they usually are used to testing one physical characteristic, and they put a lot of work into testing that. So they will do ultrasound testing, for example, on a bar using very high-end machines. And sometimes, because these are physical items, you will find a bit of porosity inside a bar, or a little signal where you're not quite sure. And then if you're a vault, what do you do? Well, the guys there probably say anything that's not completely clear, I'll just reject. And so the refiners will be saying, well, this is a perfectly good bar just because it's got a little mini air bubble in there. Doesn't mean it's bad. It's according to specification. So what we essentially presented is, look, you don't have to rely on one test so much because you can also test electrical conductivity. Silver is the most conductive metal in existence. It's very hard, almost impossible to fake electrical conductivity of silver. Gold is also very conductive. Tungsten is 3 times less conductive than gold. So, very easy to detect that. The celerity, which is the speed of sound through a metal for tungsten, is quite a bit higher than gold. So again, very easy to find with an ultrasound versus their inserts. Magnetism, as I just mentioned, X-ray spectrography gives you an idea of the surface of the bar, which is good add-on information. And then density is the standard test, basically. And so the trick is, if you test 2 or 3 things, you don't need each test to be absolutely certain. But the more of the physical characteristics you do, the more certain you are that it's a real bar. So we're currently creating an ISO 17025 system on this, which will then allow us to essentially train people on how to use it. And it's a type of standards that the refiners, analytical labs also use. And by doing this, we're also working with a company which might automate some of these processes. So there might be possibilities that it will become an industry standard overall. And for us, we had to develop it. It had to be practical, as you mentioned, had to be scalable. It also had to be reliable because we guarantee it. So we managed to, achieve all of these things in a practical sort of environment. So it works out very, very well.
And I feel I have to ask, since you've started doing this testing, have you developed a sense of how much fraudulent gold and silver is in circulation? Is this something that, you come across frequently or infrequently?
So for us, no, because a lot of our metals are coming directly from the refiner or from a mint. And when they're being transferred, usually it's also okay. We have a big facility with armed security, auxiliary police, and so on. So people just don't tend to bring fake bars for us. So would rather try their luck with a pawn shop or something like this, if they were to try that. So usually if we find something, it has to be a pretty good fake, and it was probably not intentional. So for that reason, we don't encounter a lot of these issues. But there have been the smaller bars, the retail bars, these tend to be more of an issue, where in China, there were companies that manufactured bars which looked exactly like a Pamp bar or a Purse Mint sort of bar with the packaging and so on. It was packaged, so people didn't want to open the packaging. And I must tell you, almost every fake bar comes with a certificate. So don't think the certificate is sort of any kind of guarantee. And it usually is packaged, so it's harder to sort of test. And these bars usually have a tungsten core, so that the weight and shape, the mass basically matches. So what we did is we ended up pretty much equipping almost all of the pawn shops and all of the jewelers in Singapore with ECM, electrical conductivity machines, testing machines, and they can go through a bit of packaging. And with that system, essentially, these shops were able to detect some of these cases. I think your biggest risk of getting fake bullion is if you buy it through eBay or something like this from an unknown person. And especially if you buy gold at a discount, and nobody will sell you gold at a discount. Most likely it's not the real thing. So those are things you have to sort of be aware of. But overall, in our business, we found very, very little fake cases. I remember one case of an old lady. She had some iron bars and she thought it was platinum. It was sold to them as platinum 30 years ago. It was sort of a sad case, but that wasn't even a fake platinum. It was basically just a steel bar, which she didn't know. But as I said, we've had very few cases. Maybe I can tell you a couple of stories. We had one set of big 1,000-ounce bars being transferred in as part of a big transfer. And these were bars from 1985, made in Poland, which means that was Warsaw Pact, USSR times basically. And these bars had a really high, uneven sort of porous hole sort of bars. And we had to put them underwater in order to get contact with the ultrasound. And those were really problem to test. So we talked with the client and said, look, can we just send it to a refiner, have it melted down? And it was coming from another company. And so we said, look, if it turns out to be a problem, you're going to have to pay for the remelting and for the bar to be real. If the bars are fine, we're going to pay for the remelting. And the bars were fine, so we ended up paying for it. But it's okay. It was a learning way, and the client got new bars out of it. So over 12, 15 years, we got a lot of sample data and learned essentially, how to deal with special cases.
And I wanted to ask you about being in Asia, being in Singapore. You said when you started this journey, you were already living in Singapore, found out along the way that it's much better to operate locally rather than globally. So, why did you choose to build the business in Singapore and to remain in Singapore?
I moved to Singapore. So my background is I'm originally German. I grew up in Italy. At 17, I moved to California. I spent 12 years in California. So I lost my green card application. I said, well, screw this, I'm going back to Europe. In Europe, I ended up working in Germany for 2 years. I paid nearly 80% taxes. And I said, this can't be it. I did 2 trips around the world, looked for a better place. I found Singapore. And what convinced me was a book written by the prime minister back then, Lee Kuan Yew, which is also the founder of modern Singapore. And in this book, he basically describes why the laws are in Singapore the way they are, and how he really transformed a very poor country into one of the richest countries in the world now. And the laws just made so much sense. I was just so impressed by it. So I said, well, I arrived back in Germany, I went to my employer and said, hey, can we open a subsidiary in Singapore? Because I'm moving to Singapore. They said, no, we cannot open one while I'm moving anyway. So I moved to Singapore. And to give you an idea, my 80% taxes, I ended up working for my old employer from Singapore. Singapore said, well, if you're earning some money in Germany, we don't care. Germany, because Germans get taxed on residency, I didn't have to pay German taxes anymore. And doing the same thing, working with the same employer, I quadrupled my salary, essentially. But then later I had to get a local PR green card equivalent. So that's how I started working for Commerzbank, and then all of that happened. But coming back to your question, I think Singapore is the only country I've found where I believe the government is doing what's best for the population, for the long term, in a very pragmatic way. And I can talk for hours about it, so I won't go too much into why that is, but I'll tell you the 3 things I tell clients why Singapore is a good place to store precious metals. And the first one is Singapore is extremely wealthy. Now, there's a chart out there by Visual Catalyst, which might show Singapore as being highly indebted, but that's a very misleading chart because Singapore has a fully funded pension system, and the money in the pension system is lent to the sovereign wealth funds of Singapore. And Singapore has 2 of the 10 biggest sovereign wealth funds in the world. And since that money gets invested, and for whatever reason, the IMF considers that a debt of Singapore. And because they have so much money, it shows up as them having a lot of gross debt. But you add the net asset and you will find Singapore has a lot of net assets. They have no debt whatsoever on a net basis. And it's illegal for them to actually constitutionally to have a budget deficit over a 4-year government period. So it's a very, very wealthy country. And because they're so wealthy, they're not going to be in a situation where they would have to nationalize gold because of a currency crisis or some other problem. So it's good to store your place in a place that is wealthy. The second important point is all that wealth is coming from essentially foreign investors or people which trust Singapore to build the semiconductor factories or other investments in Singapore. And keep in mind, 20% of all semiconductor manufacturing equipment is coming out of Singapore. 10% of all wafers are coming out of Singapore. And that's a huge pharmaceutical production, huge financial center, of course. And a lot of people don't know that, if I'm not wrong, Singapore can refine about 1.5 million barrels of oil per day or something like this. It's about 50% of the Saudi Arabian oil refining capacity. Most of Australia runs on Singapore refined oil, essentially. So it's a small little state, and people think of it as tourism and finance, but there's really so much more to this country. And all of this will go away if Singapore were to start doing things which remove the trust. In Singapore, essentially, it was built on trust, was built on confidence. Lee Kuan Yew was summing up Singapore with confidence. if we ever betray the confidence of investors or of people in Singapore, then we will lose all this wealth, because it's based on doing the right thing, essentially, and developing the trust for people to invest. And so the government knows that they have to play by the rules, and they will play by the rules, and they need to remain neutral. And that's also a second good reason why it makes sense to store gold long-term in Singapore. It's essentially that Switzerland of Asia. And the third reason is Singapore is extremely well defended militarily. And that's surprising because it's such a small country, but it's considered a medium-sized military worldwide now. We have a national draft for about 2.5 years. There's an army of about 400,000. So can be called up. The military budget of Singapore is around $17 billion US, which is about 3 times bigger than, say, Malaysia, which is the next biggest country. And if I'm not wrong, per square kilometer, Singapore is spending about $21 million in defense per year, which makes it the most highly militarized sort of country in the world. So I did manage to have some discussions with some ministers as well, because small countries was easier to meet them. And, so we're saying essentially that if you don't have a strong defense, then when a big country tells you to jump, you can only ask how high, but we don't want to ask how high. We want to ask, why do we have to jump? And then basically decide to jump or not to jump based on whatever we perceive as being the best interest of Singapore. And so regionally, Singapore now is actually considered sort of one of the larger military powers. And it gives Singapore a certain amount of independence in this new world. And so it's a little bit like a porcupine, a little bit like Switzerland is. Switzerland has all these mountains, and people decided not to mess with them during World War II, partially because they were neutral and played an important function, but also because they were just very well defended. And Singapore is like that in many ways. And so if you store your gold, storing in a place which is rich, which plays by the rules and has a lot to lose if they don't play by the rules, and is well defended. And Singapore fulfills all of these boxes.
And clearly, a lot of the current interest in gold is because of a perceived loss of trust in the United States with some of the recent foreign policy moves. And I was curious, when you look out at the gold market now and have conversations with clients and potential clients, what are you thinking about the current environment and what it may mean for precious metals going forward?
Precious metals are going to play a very, very important role going forward because, of course, you're familiar with Ray Dalio. And there's this idea that great empires and reserve currencies essentially tend to sort of grow and wane at some point. And I think as reserve currency is all based on trust, and as we're having this fall in trust in the United States, as you mentioned rightly so, people are asking themselves, what's going to come next? And the reason why I'm in China right now, why I'm in Beijing, is because I want to try and understand China better and see whether China can be that new reserve currency, versus the yuan can do that. And I think China is extremely resilient. I'm quite impressed by the country. But at the same time, I don't think they want to become the next reserve currency because they want to keep the capital controls up for a number of different reasons. And so China probably is not going to become the next reserve currency in the next 5 to 10 years and doesn't want to be. The euro, I don't think it makes sense. I think the Japanese yen doesn't make any sense, which then means that there isn't much left out there other than gold. And if you look at central banks, they've been buying quite a lot of gold. Most of the big European countries like Germany, as well as the United States, 70% of the assets are in gold now. Turkey is 100% of the assets in gold. And countries like China have been increasing their gold holdings by a lot more than people realize. I purchase of the sellback of gold here in China. I happened to be at a local bank branch. Somebody was selling back a pretty substantial amount of gold. It was about 3 kilos. And they were doing this density test, which is very curious to see. And it was also of public, which was also interesting because I think in the West you would want to do that behind closed doors, but it was very visible. But the interesting point is the gold price in China is 3% above the spot price in most of the West. And China has essentially been paying more for gold and encouraging a small number, 18 to be exact, companies which are licensed by the Shanghai Gold Exchange to import gold into China, allowing them to make an arbitrage profit. They basically buy gold outside of China, physical, say sometimes through other countries, brings them back into China, and say earn, I don't know, 2 or 3% sort of profit out of that. And that's not very traceable the way it's happening. So I have it on account of some very reliable sources said there's at least 4 times more gold that has been flowing into China than is officially accepted internationally. And so the Chinese for a long time now has been stacking up on gold, as they've been reducing their US dollar holdings by about 23% over the last 2 years. And they're also not allowing for exports of gold. If you are a manufacturer of jewelry in Singapore, for example, and you want to get jewelry manufactured in China, you have to send in 50 kilos of scrap gold to get 50 kilos of jewelry back out. You're not going to get 51 kilos. That 1 kilo is not coming out. So China is like a black hole of gold flowing in. And if you look at all of this geopolitically, it makes a lot of sense, because if ever the time comes that the US dollar is going to go into a currency crisis, then you want to have some assets that everybody believes is valuable. And in a crisis, gold is going to be that asset. But at the same time, because the price of gold is really determined in the future markets, and it's not that dependent really on physical supply and demand. If you keep on buying this gold this way, you can basically accumulate large amounts of gold without too many people knowing necessarily. And so I see all of that as sort of a preparation for the possibility of a financial war. And I would argue we probably are already in a financial war. But if we extrapolate on what China could do, and let's remember that the United States right now is really sort of annoying China. Chinese champions have been attacked. Huawei is a good example. BYD, other companies. We then the United States has all these restrictions about semiconductor equipment. And it's not just US equipment. I mean, companies in Holland, right, are being forced not to export goods to China. So China still, of course, resents that. It's like an embargo. And then certainly, of course, we've got the tariffs, which lately have sort of been increasing, but they've been around for a while. And I think every time you create these tariffs and you put additional embargoes and so on, the cost of retaliation for China becomes lower and lower. If you increase your tariffs now from 140% to 280, well, who cares? It's already sort of impractical to trade now. And so the cost of retaliation is going down. And if you look at what China could do, to one degree, as was in the media recently, they could start selling US bonds. But I think there's a much more drastic things that China could do. If China were to say, I'm not going to allow Chinese companies from accepting US dollars, then you would create a massive shock to the system, because everybody trading with China now would have to sell the US dollars. And keep in mind, exports to the United States for China is only 13%. 87% goes to other players. But if these other players all have to sell the US dollars to trade with China, then that can be a massive, financial attack on the United States. And I would imagine that the way the United States would retaliate would be to say, well, we're going to sanction every Chinese company which doesn't accept US dollars. And then you have a stop of trade. And that throws a nuclear sort of trading scenario, which could happen if these things really get out of hand. And in a scenario like this, how do you start again? And that's a very interesting book. I don't know if you read it, Currency Wars by Jim Richards, which sort of directed quite a bit of my thinking as I built the reserve facility. And in this book, he was playing financial warfare games for the Pentagon. And he was actually playing China. And it was a similar situation which was being created, the one we just described. And the way he ended up, quote unquote, winning was by putting the Chinese gold in Switzerland in his game, and forcing everybody, or telling everybody, if you want to trade with China, you're going to have to put your gold into Switzerland as well. And it's being held by a neutral party, which you can all trust. And it's physical gold, which means apolitical. You don't accept the yuan, I don't accept the US dollar, but we can all agree that the gold is valuable. And with that system, we kind of restarted trade. And as we're looking sort of at the future, I think that there are geopolitical considerations that it makes sense to have gold ready to act as a backup for the US dollar and the yuan and everything else when things really come to a head. And you will have to find some jurisdictions that everyone can agree on is reliable. And these jurisdictions, are places like Singapore, like Switzerland, and so on. And so in many ways, I think that gold is going to be the fallback when things go really bad. And it's just that over the years, it's sort of gone from trying to protect against the financial system collapse to now going to, you might have geopolitical sort of financial warfare coming as well. But again, it comes back down to the same thing. Gold is going to be there and it's going to have value.
And if you're going to have gold be a much more prominent piece of the financial system, we've talked about the hard infrastructure, such as vaults that need to be built, trust that needs to be built. I'm curious also about the financial technology piece of it, because we've all become so accustomed to a very electronic, digitized financial system. You began your career as a software engineer working in banks. Have you been thinking about what financial technology needs to be brought into the gold market in order to help it assume more of a mainstream piece of our financial system?
A lot, and worked on them a lot myself. So I never stopped being a software engineer. I still spent almost half my time on software systems, and almost all of our systems are built in-house. I would say, let's talk about two broad categories. There is the idea of a tokenization, which of course has been all the rage in the past. We ourselves have created such a token, quite a sophisticated one. We spent 4 years on this. Unfortunately, what we realized is that regulators don't like it. And at least in Singapore, it came to a point where laws were changed in a way that it became a regulated financial product. And that basically took away the value of it, because the idea was to have a token that you can freely send to different entities. So it's not a technological problem. There have been something like 150 different gold tokens out there. Gold Paxos and gold Tether are sort of some of the ones out there. The problem really is, how do you monetize it? Because if you think about stablecoins are a great way of making money, because you're ultimately having something like the US dollar, which is a depreciating asset. It falls in purchasing power every year. And to make up for it, if you hold it at a bank, they have to pay you interest. If you're an issuer of such stablecoins, then basically you get interest for free and you make a ton of money. But if you're holding gold and you tokenize gold, you don't get interest on gold, and you have to pay insurance and storage and other fees. So you actually have expenses. And so you have to go to the crypto users or entities that want to use it, and you have to charge a storage fee. And these people are used to getting things for free, so they don't want to pay a storage fee. So monetization is a big problem. But the other huge issue really is, if you have a gold token out there which is freely transferable, regulators, it was the SEC before in the case of Paxos, it was MAS to some degree with us as well, which said we want to have a strong implementation of what's called the travel rule, which basically means whenever there's a transfer from one entity to another, we want to know which entities these are. And if you go to Ethereum blockchain or Bitcoin, it's not how it works. And that's essentially where, at this point at least, I think if a truly sort of sizable gold token is freely tradable and it becomes viable sort of alternative to payment system to the United States dollar, a lot of countries and entities are going to have an issue with it. So politically, it's just not something that can be done. It's nothing to do with technological restrictions or so on. It's just monetization issues and it's a geopolitical landscape which doesn't allow it right now, and regulatory wise. But the other side, so, is on technologies having to do with gold, is how to make use of gold. And there are some ways which I don't like. One of it is leasing of gold. So oftentimes when you buy a savings account in gold or some other sort of gold product, it tends to be an IOU. You don't own that gold. It's something which is held on a balance sheet in a different entity, and you have an IOU to set. And that entity can choose to monetize that gold in many ways. One way is to lease it out to another company or to use it as inventory. So you're basically financing another company for it. In some cases, you can lease it out to a gold mine that's going to build gold miner, which builds a gold mine and says, in 10 years, I'm going to give you back the gold, hopefully. Is the problem with that approach is it's no longer systemic wealth protection. If something goes wrong, you don't have your gold. So you cannot get money or interest out of gold without increasing risk. And so there's quite a bit of leasing out there. I made it a point to never do any kind of leasing and make it impossible for us to do because gold is never held on our balance sheet. It's always in the name of the client. Another thing that tends to happen a lot are repo transactions. So the big, large 4 bullion banks, HSBC, UBS, ICBC Standard, and JP Morgan, together they formed the London Precious Metal Clearing Limited. And essentially this is sort of the clearinghouse which processes something over 50 billion US dollars of gold transactions per day. Almost all the physicals going through this entity. And they like to do repo transactions. So repo transaction means that an entity needs to borrow some money and the bank says, okay, I'll buy your gold right now and you can buy it back at a higher price later. But I might not have that gold anymore. We might be getting some different gold. And of course, they can use that gold for all kind of other purposes, including unallocated storage and so on. And you end up having a construct ultimately where that gold gets encumbered 20 to 50 times. So again, that's something I don't like. But the one thing which I think is going to change the way gold is viewed is collateralization. And collateralization basically means that, let's say that we're doing it at a sovereign level right now. Let's say you're a country like Argentina. And let's say your sovereign debt isn't that good because you defaulted in the past. So if you want to borrow in US dollars, let's say people want to have 10% interest from you. But you have some gold. And the idea will be, well, why don't you store your gold in a jurisdiction, let's say Singapore, where you can take lenders trust the jurisdiction and we make a standardized contract, whereby lenders will lend, let's say Argentina puts $1 billion, lenders are willing to lend $800 million on it. And because it's not held in Argentina, it's held in Singapore, and the rules are very clear and people trust that the rules will be followed. The lenders are saying, okay, I can give it a loan at 5%. So now Argentina managed to reduce the cost of funds from 10 to 5%. So it makes a lot of sense for Argentina to store the gold. It makes sense for the lenders because it's become a very low risk sort of deal now. So gold basically reduces the cost of funds. And that's a win-win for everybody, I think. Right now, strangely enough, that's not happening. And the reason it's not happening is because the big bullion banks, which will be able to have the money to do these kind of things, they make a lot more money doing repo transactions. And so I see a big market opportunity in this. And we ourselves, we created a peer-to-peer lending system among our clients to be able to do this. And we created that back about 10 years ago. We did 23,000 loans so far, about $1 billion worth of transactions over that period of time. And we never had a default. And we never had a default because we required 200% worth of collateral for silver, 160% for gold. And if the collateral ever falls to 110%, we liquidate it to make sure the lender gets the money. And if the borrower doesn't return funds on time, we have a sweeper fund, which is actually my personal money, which is there to sort of give a short-term loan to the person who's not paying on time to make sure the counterparty gets the money on time and charge a small late fee, which then grows the sweeper fund. And with the system, again, 23,000 loans, we never had a default. It worked very well. And I think we should take something like this and we should just scale it up to a sovereign kind of level. And I think that can make gold a lot more usable in some ways. So I think that's sort of what I'm sort of engaged right now to sort of try and work on in bringing this system and scaling it up to levels which make gold more practical or more interesting to hold in certain jurisdictions.
First, I want to thank you for a fantastic conversation. This learning so much here. Before I let you go, I wanted to ask, I think many people can kind of paint the picture of if there's a large crisis, the need to turn and make gold and precious metals more central to the financial system. I wanted to get your thoughts because I think is there a more gradual approach? Do you think that even absent a large crisis like you described before, that we'll see gold and precious metals taking more of a larger role in our financial system? And what do you think that role should be or will be in the future?
It definitely will be. I think there's no way of stopping it now. To give an idea, when COVID happened, our sales sort of went through the roof. But interestingly enough, after COVID finished, even 2 or 3 years later, into the state, our sales increased by about 300%. A lot of people had sort of a reality check. Since people tend to sort of assume tomorrow is going to be the same as yesterday. And COVID, I think, showed a lot of people that might not be the case. So, say, demand for gold went up and it stayed a lot higher than it was pre-COVID. And now with the tariffs, again, we're seeing a 200% increase in sales. And I do believe that the world is just not going to be the same, post-tariff stresses. And there's going to be a lot more people interested in physical gold and physical silver. And of course, with gold going up so much, we also have this event that we've got some momentum players coming in. And you have the shorter term sort of cycling of asset going up and down. But I think we also have a much bigger sort of cycle whereby gold is becoming, again, a limelight sort of product. Also, historically, when you're in a stagflation, and I do believe that's where we're heading, that's the best time for gold. When growth isn't very good and when inflation is going up, I mean, gold is probably one, and silver is one of the best things to own. And last time we were in a stagflationary period, that was the 70s. By the time we went into 1981 or so, something like 8% of all US assets were stored in some kind of gold or silver asset. I think right now, or at least last year, we are at 0.5%. So we got a 16 times of increase to go back to where we were back in 1981 or so. And so I think as more people sort of drink the Kool-Aid, the wrong pill, they sort of start to realize that it just makes so much sense to have a little bit of gold or a little bit of physical silver stacked away, whether it's under your bed, whether it's in another jurisdiction. But, you need to have something which, just in case the system goes belly up. And as uncertainty grows, I think more and more people are realizing that. And so I think we are in a long-term sort of cycle of gold and silver just becoming more and more popular.
Thanks again to Gregor Gregerson, founder of Silver Bullion Group. We hope you enjoyed the episode. We'll be back next week with another episode of Gold for the 21st Century. We hope you'll join us.
This episode is brought to you in part by Abax Exchange, bringing better price discovery and risk management tools to navigate today's commodities markets through centrally cleared, physically deliverable futures contracts in energy, environmental, and battery metals markets. SmarterMarkets are here. Contact us at sales@abax.exchange to get started. That concludes this week's episode of Smarter Markets by Abax. For episode transcripts and additional episode information, including research, editorial, and video content, please visit smartermarkets.media. Please help more people discover the podcast by leaving a review on Apple Podcast, Spotify, YouTube, or your favorite podcast platform. Smarter Markets is presented for informational and entertainment purposes only. The information presented on Smarter Markets should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Smarter Markets are those of the participants and do not necessarily reflect those of the show's hosts or producer. Smarter Markets, its hosts, guests, employees, and producer, Abax Technologies, shall not be held liable for losses resulting from investment decisions based on informational viewpoints presented on Smarter Markets. Thank you for listening, and please join us again next week.